If you look at a chart, I mean, it really looks like a tractor in first gear that just steadily goes. The volatility, yes, it is finally picking up. And that tells me that since the volatility has picked up, we probably have bigger moves ahead of us, and they're going to be both upward and downward. But when this settles out, gold is going to be at a much, much higher number, and silver will be at a much higher number at a lower ratio, I think. I believe silver is going to way outperform gold. And it makes sense because the concentrated shorts are in the silver market, which is just a tiny fraction of the gold market. So it's so much easier to bully silver with paper contracts than it is gold.
BillHolter, senior market analyst, believes silver is poised to significantly outperform gold in the coming months. The silver market, being smaller and more heavily shorted, has been more susceptible to manipulation through paper contracts. As a result, silver has been suppressed over the years. However, if silver begins to see substantial gains, such as $2, $3, or even $10 increases in a single day, it could also trigger explosive movements in gold. Holter notes that if the current trade war panic unfolds similarly to the COVID crash, silver could outperform gold by a factor of 3 as economic sentiment recovers. Additionally, a gold-to-silver ratio above 100 signals a potential global economic recession. Holter expects the ratio to drop significantly during the later stages of a gold bull market, meaning silver will likely vastly outperform gold. While gold has already seen a strong move from below $2,000 to over $3,000, Holter acknowledges that a $400 to $500 pullback wouldn't be surprising, as the metal is likely due for a correction. Despite these fluctuations, the long-term chart still shows a steady uptrend, suggesting gold will continue its gradual rise, akin to a tractor in low gear. Gold has had an exceptional start to 2025, surging nearly 25% year-to-date and reaching record highs on the MCX and COMEX exchanges. This is really driven by a combination of geopolitical risks, escalating trade tensions, particularly between the US and China, and a growing demand for safe haven assets from both institutional and retail investors. Experts predict that the outlook for gold remains positive, with persistent trade tensions, inflationary pressures, and central bank gold purchases likely to continue supporting the precious metal's price. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It's more than 15 years ago. I mean, 17 years ago was 2008, the great financial crisis. And really something needed to be done before that. And what the response to 2008 was to paper it over with more credit, more debt and more money supply. So what they're trying to do now needed to be done before 2008. And what happened in 2008, that problem got bigger and bigger, and here we are again. And now the problem is that what's different today from 2008 is back then you had the central banks of the world and sovereign treasuries of the world stepping in to save the system, to save the banking system. At this point, who's going to come in and say, and what they did was they blew up their balance sheets in the process. So now we have the same problem. And the question is, who's going to come in and save the central banks? Who's going to save the sovereign treasuries? There is no entity. And that's why I think you're seeing gold being purchased by these central banks and sovereign wealth funds, because they understand there's a huge problem. And the only way the only thing you can put on your balance sheet that'll explode upward in value when credit comes down is gold. And that's why you're seeing that's why you've seen, gold run from under 2,000 to over 3,000. Well, it wouldn't be surprising to see a $400 or $500 correction in gold. I mean, it's certainly due that type of correction at this point. But if you look at a chart, I mean, it really looks like a tractor in first gear that just steadily goes. The volatility, yes, it is finally picking up. And that tells me that since the volatility has picked up, we probably have bigger moves ahead of us, and they're going to be both upward and downward. But when this settles out, gold is going to be at a much, much higher number, and silver will be at a much higher number at a lower ratio, I think. I believe silver is going to way outperform gold. And it makes sense because the concentrated shorts are in the silver market, which is just a tiny fraction of the gold market. So it's so much easier to bully silver with paper contracts than it is gold. You put up less money, you get more bang for your buck. And over the years, they've tried to suppress silver because, and I've said this a million times, silver is the pin to gold's grenade. And silver blows up. Let's say you start seeing $2, $3, $5, $8 or $10 days in silver. Do you really think gold is going to ignore that? No, gold's going to go wild to the upside also. And gold going wild to the upside is an absolute vote of no confidence.
According to a Reuters poll, an aggressive U.S. tariff policy is expected to trigger a significant slowdown in the U.S. economy, with economists predicting a median probability of recession approaching 50% within the next 12 months. Despite a brief 90-day pause in reciprocal tariffs on trading partners imposed by President Donald Trump, the U.S. economic outlook remains bleak. The ongoing trade war with China, the U.S.'s largest trading partner, continues to escalate, damaging business sentiment and clouding the financial picture. The economy began the year on a solid footing with strong growth, consumer spending, and hiring, but is now expected to grow just 1.4% in 2025, far below the 2.2% growth predicted just last month. Inflation measures have been revised upward across the board, with consumer prices, core CPI, personal consumption expenditures, and core PCE all expected to stay well above the Federal Reserve's 2% target until at least 2027. This situation mirrors the economic challenges faced in the 1970s, as noted by BillHolter, a senior market analyst. During that period, rising inflation and a recession led to falling stock prices and stagnant real estate, an environment eerily reminiscent of what is unfolding today. Holter points out that this scenario is not unprecedented, as it is typical when an unbacked currency weakens and easy credit dries up. As a result, asset values inflated by debt begin to collapse, and the signs of this process are already becoming evident. Let's get back to the interview.
I think there's a good chance that we see a much weaker dollar, and that would also be reflected in higher yields, because if you've got foreigners selling T-bills, notes, bonds, then yields will go higher. But I mean, yeah, for years and years and years, for decades, the United States was considered a safe haven. Now I think foreigners are looking at the U.S. and saying, hey, wait a minute, their financials aren't that good. They're certainly not honest. You know, they say one thing, they make a deal, and they break the deal. I mean, the deals we've made, we don't keep our word. So I think the flight of capital out of the U.S. is going to continue and probably intensify. And I think gold has replaced treasuries as the intellectual or mental safe haven for foreigners. They're no longer flocking to treasuries, they're flocking to gold instead. You have to look at Washington and think that they definitely want to get something started with Iran. I mean, obviously, Israel would like the United States to do something with Iran. I think that is the danger. That's the flashpoint. As far as the tariffs are concerned, you know, I went on the record right off the bat that I don't think tariffs are a great idea, because if nothing else, it will slow trade. And when trade slows down, then there's less income, less cash flow generated. And you can't shut cash flow off of a system that is full-blown Ponzi. And that's where we are. We're a full-blown Ponzi scheme. You could say in the early 70s, leading up to the 73, 74 recession, I mean, inflation was heating up. The economy did go into a recession. Stock prices went down. Real estate prices were at best flat, but probably down. So yeah, we had like a mini bout of it back in the 70s. But it's not I mean, it's you can't say that it's unprecedented, because I mean, if you look at the setup, it's exactly what you would expect at some point in time, where an unbacked currency weakens toward its true value, which is zero, and then asset prices that were bid up by massive amounts of credit start to weaken in price as credit becomes less and less available.
the current precious metals market is witnessing a significant shift, with silver potentially set to outperform gold due to its smaller market size and heavy short interest, which makes it more susceptible to rapid price movements. Despite gold's strong performance, fueled by geopolitical instability and inflationary concerns, silver's relative underperformance thus far could lead to explosive gains if economic conditions mirror past market cycles. The economic backdrop, marked by escalating trade tensions and rising recession risks, is shaping an environment where both metals are gaining favor as safe haven assets. With silver poised for potential outperformance, how should investors position themselves to capitalize on its volatility while mitigating the risks associated with its price swings? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.